Hey guys, Jeff Driskel. Play for the Houston Texans going into my 7th season. Hopefully getting into the Madison market. Hoping to buy some units here and really just be a real estate investor. So hanging out with Justin today, answering some questions and seeing one of his apartment complexes and hoping to kind of emulate that model and gather up some myself. So,
hey guys, Erickson. Play for the Washington Commanders. Like Jeff said, hanging out with Justin, showing us some units, and we've been on the pro player circle with Justin the last couple months. Get some insight, get some information, and really just getting out here and seeing what he really does. So, thank you guys.
So cool. Well, if you want to shoot some questions, we can kind of just go from there.
All right. So I always see stuff on the internet about like loan to value. How much debt that you have. Do you have a certain number that you try to stay up under, or how do you try to set your company and self up as far as debt coverage goes?
So I mean, with some of the lenders that we use and like using lenders, I feel like it's hard, especially since post 07, 08. I think it's hard to get in a situation where you have too much debt because the banks are a lot smarter now. They're much more conservative. They're really not going to let you. Now that being said, like I still think we've brought more equity to the table than what is always needed. So like we're typically 65 to 75% loan to value day one.
Yep.
But you got to remember, a lot of our things are something that we're adding a lot of significant value right away too. So
right.
I feel like that's fairly safe. And a lot of these aren't necessarily loan to value constrained. They're more of, because what the bank and what the lenders are going to look at is debt coverage ratio, right? So they're more DCR rate, just service coverage as far as your debt service short on proceeds, which then oftentimes raises the amount of equity you got to bring to the table and lowers your loan amount just naturally doing that. So it's not something that we have to, obviously we pay attention to it, but the investors that we have looking at deals, the lenders that we have looking at deals, we usually find a spot that makes sense and works for everybody. And so, but still quarterly, I mean, we're like even monthly, our monthly financial meetings, I mean, we're looking at our debt amounts, our asset value amounts, especially quarterly, but even monthly, we're still, keeping that check and having it. But a lot of the deals that, relatively quickly, right, because of the value, we're finding deals that just like this one, it's well under market rate rent. We're buying it day one. I think this one was closer to 70% loan to value day one, right? But then you're in it for a year, you're in it for 2 years, you get the rents to where they need to be, and now all of a sudden you're 50% loan to value, right? And we don't turn around and, so what I don't do is we typically don't go back and refinance as much as we can get off. Like we got a deal right now, we've been in for 18 months on the other side of town that we're gonna refinance. We'll get about 20 to 40% of our initial capital back. But we could have actually gone with a lender that would have gave us more, but we're like, no, we're good. We're good at this debt amount because that one I was actually like more reserved than what the lender was. So we're not adding that value and then just the next day going to increase the loan amount, because what I view that's when there is some risk, right? Because think about it, like we're coming in, we're being pretty aggressive with so what if like 2 years from now, if this building's $15 million, right? I won't go out and go 80% loan to value against the 15 million number at that date, because we added so much appreciation over time that it's real, but it also could evaporate quicker because of how quick we did it.
So you're doing a deal-to-deal basis.
Deal-to-deal basis. But I'm never going to go full tilt loan to value. Like there's some people that doing the BRRR, and they're like going full tilt refinancing against a brand new number, and it's just not like we haven't had an issue finding and putting together to new money to work.
Yeah. Right.
And so that's just what we pay attention to that.
Yeah.
And
what is usually your refinance schedule like? Is it same thing, deal to deal?
So that again,
like a 3 year, and then we'll refinance.
Yep.
Or how does?
So that again just kind of depends on the deal by deal, right? So what we just closed in Elkhorn, which is 372 units, I think in that one we scheduled and showed in our projections a year 3 refinancing event, which again being semi-conservative, and I think getting 20 to 40% of that initial equity back to investors.
Yeah, do investors typically respond well to 3 years, or do they want to see it faster?
It just depends. I mean, we've lost investors because we don't have a set sunset on our fund either, but I know we've talked about this on the calls too, is the longer runway, the more time you have, right? The less chance for error, the less chance that you're ever gonna, we got a car coming here. The less chance for error, the less chance that anything's gonna happen that is going to make the project unsuccessful. So the way that we've always done it is, hey, it's completely up to my discretion. We don't have a set, we plan to be refinancing this deal year 3. We plan to be refinancing this deal in year 7, but it could go longer, right? Because I never want to run out of time because I just put some arbitrage. So now there are some people that won't invest with us because of that they need to be out in a certain date or a certain time period. But it hasn't been too much of an issue really. Like, and yeah, do investors respond great to that? Yeah, they respond really well to that. The other deal I was talking about that we're refinancing right now, we've had for 18 months, we bought for $33 million. Broker opinion of value is $50 million today. So some people are like, well, why wouldn't you just sell it? It's like, well, because now we got another problem. Like, we got to go find and put that capital to work. Like, all the investors, like, we've only been in this for 18 months. Mm-hmm. We still also have more room to go there with our rents and operations and everything. If we already cranked it to the max, maybe we'd potentially look at selling it. But if we're not to the max yet, why give ourselves another problem and our investors another problem of taking it off the table and now having to go turn around?
Especially when it's burning and churning.
Right, right. And it's cash flowing like crazy. And even after the refi, we'll get them 20 to 40% back. And then it's still going to be a super strong cash flow on top of that. Yeah, they're always happy to get money. You know, they're always happy to see the success of the project. Yeah. But I'll tell you right now, a lot of those investors, I haven't talked with any of them specifically, but I'm willing to bet almost all those investors be like, okay, but now where am I going to put this capital? You have another deal coming up in time so I can, put it somewhere else, right?
So for like a big fund like that, can an investor, when they get their money back, 1031 exchange that?
So refinancing, there's no taxable event there.
I guess
if you
I was
sell,
talking about when you sell.
So if we sell, everyone, I'm sure there's more than one way to do it, so because I haven't actually talked all the way through with our accountants. The easiest route would be if that same entity everyone agreed and went to, but now everyone has to agree. Everyone has to agree, and is it going to be best for everybody and whatnot? I don't know. With that many, I don't know. I know there's a lot of other people that are set up like us that they have done it. There's also a lot of people that they have not done it. So it just kind of depends, and we'll kind of get to that point when we.
That's the beauty of the refinance, though.
Right. Yeah, it's not it's a loan, right? Loans aren't taxable. You don't get taxed when you take out a loan on your house. You don't get taxed on the loan that you took for your vehicle, right? So, and the power of that too is people are always like, well, so how long till you're completely paid off? I'm like, I'll never be completely paid off on the properties because I always want some leverage, right? It doesn't mean we'll always have as much leverage as other, it might vary how much we have, just depending on the economic environment and stuff like that. But I'm always going to want some because I'm always going to want leverage. I'm always going to want to use other people's money, right? Like the bank's money, the lender's money to be able to go out and buy. For every dollar I have, I can buy $4 of real estate, right? So why would I want to change that? Plus, on top of it, the interest that we're paying on the loans, right? They're a tax write-off. So